All right, so we've been working our way through the accounting cycle in the past few chapters. And that is still the case. In this chapter, we're actually going to finish it up. So we are going to see the last few steps, and these steps make up the closing process. All right, the steps in the closing process, we're on to steps 9, 10, and 11. So step 9 is prepared after the financial statements have been completed, and that is to prepare our closing journal entries. Now those closing entries are made in the same place all your other journal entries are made, in the general journals. Okay. Now you've noticed that pattern every time after we do journal entries, we post. That's going to be the same thing here. Post to our general ledger. Every time after we post, there is a trial balance that needs to be prepared. And that'll be our last step to prepare our last trial balance. And that is called a post-closing trial balance. And then the whole process starts over again. Right, so we're focusing chapter 5 on the closing process, the last 3 steps of the accounting cycle. Just like we did in chapter 4, we talked about like the when, the where, the why, the how for those journal entries. I'd like to do the same thing for chapter 5's closing entries. So let's start with the when. When are these closing entries prepared? They're prepared at year end, so not month end, not quarter end, but at year end, after financial statements have been prepared. You'll see why that's important. They're done afterwards in just a minute, where they're just like every other entry, right? The general journal. General journal. Where all your other journal entries go. Why? The big why do we have to do closing entries? It's to prepare the company's accounts for upcoming period. If you remember back when we were learning about our accounting principles, one of them was the time period, which says that we record each period's activities in an artificial time period, right? And we say the minimum, or at a minimum, it has to be 1 year. Okay. So that 1 year time period. So that means after 1 year, we have to start the next year. Certain accounts will start with a 0. Why? So that we can track all the activity for that year, like revenue and expenses, in that upcoming period. And if we have revenue and expenses from the prior year, you're not going to be able to see how much profit is in year 2 versus year 1. We want to keep it separate so we can see how the company is improving over past periods. So that's why we have to prepare the company's accounts for the upcoming period, so that we can track its activity as it progresses through its life. So, and then how do we prepare it? We are going to close. Close means bring to a 0 balance. Close means to bring to a 0 balance. So we're going to close all of a company's temporary accounts. So not all accounts will go to 0, just the temporary accounts. Okay, and we'll go through that in another video. Okay, so these are prepared at year end after the financial statements are prepared. And I guess you can see why that's important now, because if we were to close them, we would bring certain accounts to a 0 balance before financial statements. So then the financial statements would show 0 for revenue and expenses, which wouldn't be accurate, right? So that's why they have to be prepared at year end. Usually they're prepared at like 11:59 p.m. on December 31st. Like it's the very last thing you do in that year. They're prepared in the company's general journal with all the other journal entries. They're prepared in order to ready the company's accounts for the next year. And we have to zero out all temporary accounts. All right, I'll see you in the next video when we talk about what temporary accounts are.